Okay, guys, so I'm now going to teach you guys about momentum indicators. Now, this is what markets investors can use alongside their technical analysis just to confirm if a trend is turning in their favor um, when they're getting into trades, for an example. So it's just like a confirmation strategy. But to be honest with you, you already know whether you want to be buying or selling a currency based on the fundamental ideas we've been going through. This is just going to confirm yet the trade is now starting to play out and is trending in my favor. And then you can also use your own technical analysis strategies or simply just use the support and resistance trend lines that I've shown you to get into a trade. So let me just explain the momentum indicators. Let me show you how they work on a chart, and then you could apply them on your own trading charts if you want to. You don't have to, but it's something I use. And it's just a confirmation that I think it doesn't harm you to put it on your charts when you're getting to some trades. So simple moving averages is basically moving averages that dictate whether momentum is building or slowing in a currency pair's direction. So is this currency pair trending, or is this currency pair just chalky and move it sideways, for an example? So it also dictates when momentum may be turning in a currency pair. So a simple moving average basically calculates the average price of an asset over a given number of days. So let's say the asset we're looking at in the trading chart is, for an example, the US dollar South African rand, and let's say the last 7 days price has been 10, 5, 8, 4, 6, 1, 4, 8, 11, 40, 16, and 11, for an example, over the last given number of days, over 12 days that is. These are the average price of that exchange rate, for an example. The average price, as you just add them all together and divide it by 12, you get the average price of 8.1. So the average price of the last 6 days, for an example, these last 6 days here, would be 10.6. So what basically explains you how the moving average works. So you can look at the last 12 days and get the average, or you can look at the last 6 days, and get the average over here. So that's what we're doing. That's how the moving average works. It just basically averages out the average price over a given number of days, whether the last 12 days or the last 6 days, or either the last 30 days, could be the last 24 days, could be the last 100 days. You can use the momentum indicator and you can change the amount of days, but I will show you the correct days to focus on to make sure you get the momentum indicator working in your favor. So again, guys, it just averages out the price over a given number of days. Now, professional investors match up two simple moving averages, which each calculates the average price over a different number of days, so trading days in an exchange rate. And the strategy is to wait for the moving average that's calculating the less number of days to cross above or below the longer term moving average, the signal that a trend is forming in the market. So for an example, when the average price of the last 6 days is 10.6, and the last 6 days goes above the average price of the last 14 days, so we've seen here the red crosses above the longer term moving average. This is basically showing you that momentum in the short term is now pushing to the upside, and this gives us a bullish confirmation that this currency pair may now start to be trending to the upside, because remember the shorter term moving average is basically got the average price over a shorter amount of days, and the longer term moving average is looking at the currency pairs exchange rate price over a longer period of time. So when you get the shorter term moving average cutting above the longer term moving average from below, that's indicating, well, in the last few days, however long this moving average is, that's the shorter one, is showing you that momentum is now moving to the upside. That's why it's cut above the longer term moving average from below, and then we see the market moving to the upside. On the flip side, you could have it where the shorter moving average then cuts from above the longer term moving average and cuts below it, and then our signals that the momentum is now moving to the downside, and then we get the market that trends to the downside. So what moving average levels do we use? Well, as we know, the Forex market trades 6 days a week. So if you are, for an example, you want to trade between 1 week and 1 month windows. So let's say you want to really get into a long-term trade. I trade long-term trends in the markets. I hold my trades sometimes for 3 months, 4 months, 5 months. As low as the market's trending, I'm not closing my position because I want to keep adding new positions. I just keep rolling my stop loss, which I'll be talking about. I just lock him in profits and profits and profits. I don't personally like to get into short-term trades unless I just see a mispriced opportunity in the market cause my summer event, and I might take a short-term position just to make a bit of a profit in the market. So 6 days equals 1 week, 24 days equals 1 month, 72 days equals 3 months, 144 days equals 6 months, and 288 days equals 12 months worth of trading, as all based on the 6 days that we looked at for 1 week's trading. So for an example, 6 days is 1 week, 24 days is 1 month, 72 days is 3 months. For an example, 144 days is 6 months. So what we want to be looking at, guys, if we're going to be trading the markets, personally, as I was just saying to you guys, I like to trade over 1 month windows. So I will match up a 24-day moving average, for an example, and a 72-day moving average, because I like to catch long-term trends, okay? And this is going to make sense now when you start to look at my volatility analysis later after this video, when we start to look at risk management to make sure that your accounts are protected when we're getting into a given trade in the markets. So for example, here I've got 24-day and a 72-day moving average. So let's say when the pandemic struck, that we understood that emerging markets become very vulnerable when there's really unrest in the markets, and markets like to just basically take their money and put it in a safe place. So they buy like secure government bonds instead of being in the stock markets, for an example. When the stock markets in South Africa crashed in the early parts of the pandemic, money basically just left South Africa, rushed into the United States, and investors just pushed their money into the US dollar and bought US government bonds as a safe places to park their money during the pandemic. And this caused the dollar to really get stronger against the South African rand. So let's just say you, in retrospect, understood the flow of money, and then the shorter term moving average, the 24-day cut above the longer term moving average, 72 days. So the 1 month moving average is moving across the 3 month. Then you must have buy the current pair, for an example, or you waited for the break of the resistance. Now you could have literally held that trade all the way up until, for an example, this crossed back over to show that now the trends moved to the downside. So you had made a profit of this much before the crossover happened, for an example. But to be honest with you, you would have understood why the markets then started to move lower anyway, based on the economic data and all the stuff you've been talking about in the course, for an example. So let's say you understood the markets that was then moving to the downside, and you understood why. You could have waited for this crossover to go downwards. Let's say you didn't catch this move, but you was looking at catching the move downwards. You could have waited for the shorter term to cross the longer term from above down below to signify the trend is moving now to the downside. And then you could have been using your technical analysis strategy, which I was showing you guys on this exact same exchange rate, to get into the downward trend in the market. So if you just understand the moving averages, you can match them up and you can use that in your favor. But just use the ones that I've told you guys, because this is really what the markets are going to be. These are the main moving averages, because it averages out 1 week, 1 month, 3 months, 6 months, for an example, when we're trading currency. So they're the ones that I personally, guys, pay attention to. And it's just a momentum indicator. It's just showing you, is momentum building in the direction that maybe you be thinking that a currency can maybe going, and it's just going to support your view to, okay, let me get in this trade and let me make some money from this now, because the momentum in the moving averages are telling me that it's now aggressively pushing in one direction. If that direction matches up to your fundamental bias, now you can start to use risk management strategies to get into trades and use technical analysis to time that trade in the markets, guys. So hope that makes sense. And that's a momentum indicator, guys, that I use when I'm trading. Thank you.